Hey everybody, welcome back to Markets for Millennials. Happy Friday. Today is April 1st, and so this is the weekly market wrap from March the 28th through April 1st. And as you can see, what I've got on the screen here is the US 10-year minus the 2-year, and the big story this week is the yield curve inversion. Now, people looking at the like euro dollar have already been talking about inversions. People looking at futures have been talking about inversions, but I've been watching this chart specifically because it's calculating the real-time rates. So obviously, if I were to click on my US 10-year, you can see where we're at here. And then if I were to put something like US 02-year, and actually I gotta click this, then you would see that. And so obviously you can see the 2-year has just gone parabolic, and that's because people are selling it like crazy. And one thing actually that I just heard, let me try to do this really quick in real time. I apologize. 2-year. Oh yeah. So I was hearing a lot about this. Even the 30s minus 2 inverted, which is just insane if you really think about it. And so people are really heavily selling shorter term treasuries instead of the longer term treasuries. So that's why obviously the US 2-year yield is going up, because there is there's much more selling of that on the market. But anyway, oops, excuse me a second. There we go. But I'm starting here because everyone's talking about the yield curve inversion, and historically, if I go to a weekly chart, every time a yield curve inversion takes place for the last 40 or 50 years, a recession has followed. And so what I wanted to spend the first few minutes talking about before I go into the markets is, or the rest of the markets I should say, is what is it that we should expect. And the timetable for this, I would venture to say, is somewhere between 6 months and 24 months. And I'm kind of going off of how, if you go back to the most recent inversion in August of 2019, then our next recession, it was a little bit over 6 months till we got to March 2020. Then obviously we had the GDP going negative, and the recession. When we talk about a recession, it's not necessarily talking about the stock market crashing, although the stock market often does crash or does correct in recession, but it doesn't necessarily have to, and it doesn't necessarily have to be a long crash. It can be very quick, but a recession is typically what happens when you have negative growth for a certain number of quarters in a row. So obviously you have to look at GDP for that, and so anyway, that was a really quick one that took place. But then there have been others. If I were to pull back, I should have gone to a different chart, but But if you go back here, you can actually see our first inversion prior to the financial crisis, the great financial crisis, which kind of really the top of the market was 2007, and then the bottom of the market was in March of 2009. So that was kind of a 2-year bear market essentially. But you can see that the first inversion, if you look at where my crosshairs are, was in December of 2005, and so it was a year and a half. Let's see. Yeah, it was about a year and a half actually. If I were to let me go to the S&P 500. You're gonna see some things on my chart. But if we go to the S&P 500 and we look at where the top of the S&P was, October 2007, that means that it was almost 2 whole years that took place before the crest of the market top took place, and then it was another year and a half before the bottom of the market came about, and so all that is to say that a lot of time can pass before anything really substantial takes place. And so what I also did was I went onto the Fred database, and I'm sorry the page is a little bit cut off for you guys, but what I'm tracking here on the page is I'm looking at the GDP, which is the blue line, and the scale is on the right, so GDP growth. And then on the left scale, which you can't really see, but it's basically 3, 2, 1, 0, 1, 2, 3. -1, -2, -3. I'm sorry. And the red line is the 10-year minus the 2-year, so the yield curve. And so what's cool about the FRED database is that it grays the areas which are considered to be recessions. And so this is going back obviously to the 1980s. And I started there, I tried to go back as far as this would let me go because what has really mattered a lot about GDP versus recessions, more so than any other time in history, has been the time since the United States went off the international gold standard in 1971. And so I wanted to track from that point. And so what you can actually see is if we just follow the red line, because typically what happens is it's not just the fact that the blue line goes down, it's that it goes down for a certain number of quarters in a row. And so what I wanted to show you here is if you just follow where the red line takes place, and you could see that we had an inversion here in 1978, quarter 3, 1978. Oh, sorry. Quarter. Where are we? There we go. 1978. We had the yield curve invert, and then we had a recession in the early 80s. Then the yield curve inverted again after coming positive, and then we had another recession in 1981, 1982-ish, somewhere in that area. And then it was a while before, after we came up above, it was a while before the yield curve inverted again. And when we did get that first inversion, it was 88, and it wasn't until 1990 until we got a recession. So what this is really useful for is for helping you to see typically, how long does it take for the yield curve after the yield curve inverts on the 10s and 2s before we actually get that recession. And that's why I say we're looking at somewhere between 6 and 24 months. And obviously that's a lot of time. And I know that the uncertainty is difficult for people because ultimately what that means is, people want to say, oh, it's a recession. Recession starts at X time, and that's when I'm going to, be a short seller, or that's when I'm going to get out of the market. And the reality is that you don't know. There's no indication really of, there's no real indicator of the when. It's hard to tell, and that's why you're seeing a lot of noise about it. Everyone and their mom, it seems, has an opinion on when it's going to start. But all we can do is track price. And so there's some things I want to look at on the equity markets because obviously I would say that equity markets in general being the most popular, there are ramifications for that. And so I think that obviously the barrier to entry in, say, crypto and stocks are the lowest. So we'll start with that. But the idea is we still got to follow what price is showing us. And right now what price is showing us is a couple of mixed signals. And I anticipate that, as with anything that happens in the markets, when you have a news event, when you have something that is widely publicized like a yield curve inversion, I think it's normal to see some selling taking place just in response to that because of the fear. But in reality, let's let me turn the line chart on really quick. And what I'd like to do is again, because it was August of 2019 when we had the last inversion. So if I just start at September 1st. Let me find September, somewhere around September 1st. So that let's do September 3rd because that's the first day following Labor Day. If we just start from September 3rd until the top of the COVID, before the COVID crash, the S&P 500 went up almost 16%, just a hair under 16%. If I come back to my FRED database here and we go to when the yield curve first inverted in December of 2005, let me go to December of 2005. Boom, 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 boom. Sorry about that. So we're going to go December 2005, and we're going to track until the top, the market top on the S&P. So let's see here, December. And we'll just start at December 1st. It's just easier that way. December 2005 to the top. we went, almost 25%, barely under 25% up. And let's go to, let's see, the most recent, the one before that in 2000. So we had the inversion take place. Where is this? This inversion looks like it takes place in February 2000. And then, so let's see, there we go. February 2000. This one's a little bit shorter, looks like. So we'll go February, excuse me. All right, so it looks like we're going to start February 2nd, and then just the top of the market was another 10%, but this one only took place 51 days later, right? So in my mind, what you take from this, or what you should take from this, is that you have to be really careful, and you have to protect yourself as best as possible, and still be watching price as your main indicator. Have proper stop losses. Be careful about new positions. Make sure that, because you can always be dollar cost averaging, say, into stocks or something like that. Just be mindful about how you protect yourself. Be mindful that you can remain solvent, and that you won't get shaken out. Make sure if you're buying stocks that you are buying into companies that are more resistant to recessions, and have more solid fundamentals. So you want to see low debt, and things like that. But on the equity indices, my point being that now, let me go back to my yield curve just for a hot second, because I want to say, so let's see. Yeah, today, today we got our first close on the yield curve today, April 1st. And so it could be, what was it, like a couple of months before we get that, before like a top in the market. Or we could just roll over. I don't really know. The thing you have to remember is, what happens in the past doesn't necessarily guarantee to operate or to happen the same way in the future. And in this case, we have the Fed raising rates into a slowing economy during a period of extremely high inflation. So anything could happen. This could just roll over. However, here's what I wanted to show you, and I've got this right now. I'm going to start with the Fibonacci levels, and then I'm going to take a look at the moving averages. So you can see here on the S&P, and this is something I've been tracking over the last few weeks, but especially over the last week or two, as price started to approach the 618 retrace. And there are different price behaves differently on different indices, just like in the March 2020 crash on the bounces. It happened at different Fibonacci levels across different equity markets, but obviously the Fibonacci levels are important, just even from a psychological standpoint, and then obviously Fibonacci levels have historical significance and natural significance out there. So you could see that right now we are resting right around the 618 retrace. We were actually able to bounce up high and get right underneath the 786 level. We did make a higher high, which is what I was watching for. We did make a higher high than our swing high from February, from the the 2nd and from the 9th. And so I think that that's a positive thing, that we didn't start dropping down underneath and then going and rolling over and making a lower low. But this also could be a relief rally, and I'll show you in a second what I'm saying there. But you can see that we are, in terms of technicals about making a higher high, that's obviously a good thing. But it's not a good thing that we have not been able to clear 786 and that we've actually fallen back below the 618. Let's take a look at the NASDAQ, because this one is even more ominous looking. So in terms of closing highs, we did make a higher high from those same dates on the NASDAQ, just like on the S&P. On a wick standpoint, we about matched our high from February 2nd. But you'll notice here that the 618 level falls like basically right on this close on March 29th this week. And so I think that this is a level that we have to watch, because I think it was on the NASDAQ. No, I think it was the 50 or the 500 level on the NASDAQ before. But definitely during the March 2020 crash, one of the equity indices bounced to the 618 before rolling over in that really really fast crash that took place in March 2020. So that's to me that's not a very good sign, and you can actually see that level rejected back in early February as well. On the Dow, kind of the same thing. We did close above the 618, so it's a little bit better than the NASDAQ, but we did not make a higher swing high. You can see that those higher swing highs from early February are closer to the 786 level on the Dow. And again, we're talking about a closing basis. So I think that's a really important thing to notice. And then finally, the Russell, which obviously was a laggard all throughout 2021, had the prairie dog crash down, went into the bear market first. And its bounce has been relatively muted in comparison. So again, like with the Russell, it's really interesting to watch that the Russell, when the rest of the equity indices are crashing, or I should say correcting, in this particular case, you had the Russell actually outperforming because it was just moving sideways while the rest of the markets were moving down. But ever since the other indices have been crawling higher, the Russell has underperformed that price action, and it's looking like we're getting rejected around the 382, which, as you can see, look at how that area was support. So whether you want to use Fibonacci's right now, or you just put a trend line right at the bottom of this wick here from December 1st, 2021, and that'll provide, like if I'll just do this right here because I'm going to get rid of my Fibonacci levels in just a second. You can actually see that level is exactly where we got rejected. And it's basically where we closed later in December too. So that's a pretty important, these are pretty important levels. It doesn't really matter which index you're talking about or they each have their own Fibonacci level that they're messing with. The S&P with the 786, the Dow and the NASDAQ with the 618, and the Russell with the 382. Now, having said all of that, let me pull up my major moving averages. These are the 50-day, 100-day, and 200-day simple moving average. And on the Russell, you can see the 50 is starting to curl up, but the rest of the other two moving averages are down, and it looks like we're getting a rejection. Not only on that, again, let me put that line down again, not only on that horizontal line, but that lines up also with the 100-day moving average. So that yellow line is the 100-day, and I think that's particularly significant because in the same way, if I recall correctly, I don't know if you could tell, you can see over here on the right side of the screen, this 15251 level is around the same place as the 618 ratio. And so I've had that resistance line for some time, ever since, well, we definitely tested it on February 2nd. But then you'll also see the 100-day moving average and the 200-day moving average are providing some resistance there as well. So that's a much bigger confluence that you're seeing there. And so actually, let me get rid of my Fibonacci levels so you can see it more clearly. So that's concerning to some degree. On the Dow, if I get rid of my Fibonacci level, once again, though, you can actually see the confluence of all of these lines, whether it be the moving averages, the Fibonacci level, or a horizontal resistance level, as you can see here at around 35054, which again, that's been there for some time. I'm pretty sure that I put that down here on the 11th of May or so of 2021. So obviously these are not date stamped, so I can't really go back and check, but I'm pretty sure that line has been there for some time. So again, really interesting to see the indices coming into this, into these levels and having some trouble. As you can see, like just looking again at these indices, the rally has kind of stalled out here over the last few days. Here we are looking at the S&P, and the S&P is a little bit different. We got above all of our moving averages. We got above the 618, and I know we ended up below the let me go back, hold on. I know we got below the 786, and we are technically closing below the 618, but we were able to get above all the major moving averages and it looks like we're in the process of testing them as support. In fact, this bar, if you zoom in, it's actually closing for today above. So we actually went down below, but then are now closing above. So that's actually pretty bullish, I think, for the S&P. And so the reason why I've taken the time to really talk through all of that with you is because I could see a scenario in which the equity markets not only continue to move up, but actually make all-time highs. And we could run for a little bit, even before the actual recession hits, if indeed we do have a recession, as history has shown we will, from the inversion of the yield curve. And so that could totally happen. We could, like, I don't know. There was, what was that one? That one where on the day from the day the yield curve inverted, that went up 15% or so. So that would put us over 5,200 on the S&P. And then if we did 25%, which is what happened on one of those other occasions, that puts us at over 5,700. So, could all of that happen? Sure, anything could happen. Or obviously, like I said before, we could also just roll over. And so, if you, again, just going back, if you go back, and I don't want to take the time to go back to these other recessions, but if you go back and you look, there's actually, like, when the inversion does happen, price almost always does appreciate on the indices. And so there's that history to consider. Yet at the same time, like I said, we haven't really been in a situation where the Federal Reserve was hiking rates into a slowing economy during a period of high inflation. And so I think the only comparable time was, I think, in the 70s, when we had the huge rate hike shock under Volcker, I think is who it was. So all that to say is, again, follow the technicals, find your levels to buy off of, or just hold your positions and sit on your hands. You don't need to always be taking action. You don't need to always be making trading decisions, buying and selling decisions. If you're uncertain, in fact, I would say the best thing you could do is just sit on your hands and wait. Again, like making sure that you are taking caution to protect your positions. A little bit of insurance for yourself is a small price to pay for potentially saving the majority of your capital in the case of a crash, for example. But then also you have to consider what action you might miss on the upside if you were to get out of the markets. Let's take a look at gold really quick. I tweeted about this, and I was going to pull it up, but I'm not going to. But it's better if I look at maybe a smaller time frame. You can kind of see on the 2-hour how gold has been playing with the support and resistance. And the point of my tweet, let me go to the 8-hour. The point of my tweet was that it's amazing that these lines that, like, when I put these lines in, it was over here between August and September of 2020. And so those lines, Q3 2020, have been there forever. And yet, like, look at all the places. If you just follow my screen across, look at the places where they were important, and then maybe they haven't been important for some time, but now they're important again because price is just bouncing around between them. So price is looking okay from the standpoint of, like, the 1916 level is a place. If you go back and watch my videos from over the last year or so, I talked a lot about that 1916 level being super important for gold. And we're still staying above there. We've wicked down a number of times and we're still above it. But then again, we're still, even amidst, like, the war situation, massive inflation, lots of uncertainty, we're still not seeing it break to new all-time highs, which I think is interesting. One thing I wanted to point out on WTI, I tweeted about this because I thought this was interesting. I took the wick. Usually I use closing prices, but in this case I took the wick high to wick low on the swing low here. And here we are with the 618. So to me, this is potentially a classic blow off top sort of price action. If you think about it, we've got these slow rises and collapses in price, and then suddenly a real big takeoff. And when things blow off, they usually need a lot of time, to shake out all of the rest of the supply and demand dynamics and all that kind of stuff. And so I could totally see a scenario in which, oil kind of consolidates down back towards kind of this bottom area, somewhere in this range, and maybe finds itself some support, because it's definitely got support right there. So I feel like, again, this range in between where the zero line is at 93.56 and maybe this support at 84.79, I could totally see a scenario in which we consolidate down close to this area, perhaps, maybe not exactly all the way down there, but that direction. I could totally see that scenario taking place before finding legs to take off again. I do think in the long run, oil is going to go up just because of all the various dynamics about ESG. I think that ESG and various the move away from investment in petroleum and stuff like that, I think that is going to be a catalyst for price increases, not for price decreases. So let's see here. I also wanted to look at, we already looked at yields. Let's take a look at the DXY. Oh yeah, here we go. So I want to show you this. Let me go to an 8-hour chart. This looks a little bit better on the 8-hour. So I was kind of watching this, and I had been saying that I expected, because it had held twice, I had expected this support, which had been resistance previously, to hold. And then, of course, we broke down. But when we broke down and retested it, I was expecting for us to come down and then maybe retest the bottom right here of this support trend line right here. If you just look at if you just follow where my mouse is and where that line is. But we didn't do that, actually. It was, and what I realized is if you take this dotted line, which, let me go to a 3-day so you can see that. It's not matching up properly right now, but this dotted line was marking kind of the top resistance from, wow, something is really off with that. That's very strange. I'll have to fix that. But anyway, I've had this line because it was marking the top of this move as well as the top of kind of after our little spike after the crisis. And now what you're looking at is, oh yeah, see, something is totally wrong here. And now what you're looking at is a situation where it's now providing, that long-term trend line is providing resistance. Now, do I think it's going to hold on that resistance level of this dotted line? I actually think the dollar will, before it goes lower, I think it will break out into the low 100 range. But obviously I am flexible with that and I'm willing to adjust. But anyway, what I was going to say was, after having now tested it 3 times, we were coming down and I was expecting this level to hold, and it didn't. But because, again, on the 8-hour chart, we kind of had these 2 candles below it, I was trying to figure out, okay, is this retesting and then going to resume down, or is there something else going on? And so what I ended up doing is, I added another line, so let me get rid of that. I cloned this dotted line, and I stuck it right here, and I'll just make it so you can see it. And it actually is making a perfect flag, perfect channel, I guess, if you want to call it a channel or a flag, whatever the case may be. And so given the price action, if you just look at the price action since June of 2021, what is that, June? Late May and June of 2021, just this uptrend, you can actually see what has happened is price moves up, then we get this kind of consolidation, these consolidations, consolidation. So I think that this is another one of those situations, and I'm expecting, and this could be sooner, so maybe it could be as early as next week we bust out of there or crash back down. Either one of those could totally happen, but what I'm watching for is to see if we get some sustained price action here before either breaking out or breaking down. And so I think that that's pretty important. I had some things to look at this week in the currency markets, but I think I'm going to save that for my newsletter, so you can stay tuned for that. If you are not subscribed to my newsletter, you can go on my Twitter account at Mr. J. Thomason and check it out. Free subscription. I put a lot of work into that. So in this case, I think I'm going to call it quits for today, as we are approaching 30 minutes, and So I hope that this was helpful. Again, trade safely, invest safely. A recession is imminent, but it could be a while, and there's a lot of room for price to move in either direction beforehand. So always be watching your risk to the downside and to the upside. And again, be safe, and I will see you guys next weekend. Have a great weekend.